Awesome! Welcome to the Portfolio Secrets Masterclass. I am so excited to share with you really how to mash Yahoo Finance and also how to use the information in the portfolio that we're about to go through to kind of understand the underlying psychology of what actually makes a really phenomenal investment. Because once you understand how to actually create a really great investment, all of a sudden, if you understand what's going on sort of beneath the surface, it's 100 times easier to actually mimic whatever you want to create above the surface. And whether that's your portfolio now or whether that's your portfolio later, really the big key is going to be understanding what actually makes something, so that once you get to the point where you're putting in your portfolio, you're actually putting in the order with your broker to get those stocks. Once you have that going for you, this is really going to be the critical key that's going to allow you to have the skills, have the knowledge, have the understanding to make the right investments so you can actually have success with it. And most importantly, so you can sort of, like most people are kind of, they have their returns, and the returns are in what are called like the majority, right? The majority of returns are usually, they're kind of average, right? And you know, this might be the range that most people are used to. This is the range that most hedge funds are used to. This is the range that almost 99% of investors are used to. And this range is usually from about, 1% or really crappy, like, treasury rates, which are ridiculously low. You got extremely low stuff here. We'll call this like 0% essentially, because a lot of people, they don't even have their money invested. They have their money in like cash. They have money in these bank accounts that are paying literally like puny interest rates. And then every single year, the Fed's going to target, 2% a year. And so if the Fed's targeting negative 2% a year with the inflation rate, then in reality, a lot of people are actually losing money every single year if it's not invested. And that's not a good place to be. That's not a great position to be in. And so that's actually where a bulk of people are. Almost half of Americans don't even own stocks. And where do you think their money is, right? They're going to give it to a bank who's going to 10x leverage it and try to loan it out at 14% to some risky third party. What do you think that's going to do for you? For most people, the answer is almost nothing. And you barely see any of those returns ever. And so that's why it's really critical, because the majority of people, they either have super low returns like that, or maybe they're used to something that is a game changer. And I don't want to diss on this at all, because 7 to 10%, maybe 15% a year is absolutely phenomenal. If you have that much, you can literally create a portfolio, a retirement portfolio over time that will change your entire life. My grandparents, my parents, my aunts, my uncles, all of my family, all of them go through this one concept of overarching long-term compound growth. And it's very simple. They just take their money and they put it in over a period of time. It's usually a very long period of time. And at the end of the day, they have this objective of having a portfolio with X million dollars in it, or however much they want. And for most of them, this comes down to what they're used to. This comes down to sort of what they expect themselves to be worth. And over time, they invest. And then through the magic of compounding, right? These the financial markets over time, they just go up and up. And it's really interesting. You can invest literally at the bottom of the market. If you look at this pie, even if you invested in the worst time possible, and you were the worst investor on the planet, and bought every index possible in the 1929, right before the worst crash on the planet, within 20, 30, 40 years, you're still gonna make money. And within right about 30 years, you're doubling your money. And then after that, you triple your money within another 10 years. And so even if you're super crazy and you have no clue what you're doing, what a lot of new investors have on their side, which is really powerful, is time. Now that's a pretty extreme example. There usually aren't great depressions. And if you look at historic stock markets and historic indexes, the markets, if you look at them, almost always and historically only go up. And there are obviously downturns, and sometimes the downturns are longer. This was maybe a 2-year pullback. This was maybe a 4-month pullback. This was maybe a 1-year pullback. But over the long term, this was actually maybe a 5-year pullback, where it went down, went up, and went down. And what happens is, over the long term, markets only go up and up. And so when you invest, and what most people do is they invest in indices, and over time, as long as they have sufficient time, their portfolio value grows and it grows. And this is how people make literally millions of dollars over the long term, just by investing in quality investments. And what's cool is we're not going to get too deep into it right now, but once you actually understand how to really game these markets, how to understand these financial systems, you can see sort of all these crashes. What's interesting is every single time, without failure, for the past 120, 130 years in financial markets, every single time there's a huge crash. what happens about a year before it usually, and sometimes a little bit more, and sometimes a little bit less, but it's happened like 8 to 12 times over the past 120 years, 130 years, is right before the crash, or right before the recession, what happens is the yield curve inverts. And what's interesting about this is, think about it like you're the U.S. Treasury, right? And I want to like give you money. What happens when the yield curve inverts is you will pay me more to give you money for 2 years than you will to give you money for 20 years, which is super, super weird, and that makes no sense whatsoever. Like, why would you pay me more to give you money for less time? And the reason that happens is because the economy gets super freaking messed up, and that's sort of the indicator, that's the predictor of some kind of pullback. That's the predictor of an incoming recession, incoming difficulties. And so, like, why I'm sharing that with you is because, like, if you understand that and you see that there's an inverted yield curve in federal treasuries, then like you can have a lot more growth, and you don't have to actually hold through all these pullbacks. Like you don't have to. If you saw the inverted yield curve in 2000, you saw the inverted yield curve in 2007, you saw the inverted yield curve in 2019. Like you don't have to actually hold through all those downturns. And you can. But I totally want you to understand that this figure right here that most people are using, this is sort of our average investing range of normal index returns. This return range right here, which I'm going to call about 7 to 12%. And right here we're going to have about 2 to maybe 5%, is what most people are used to. And what's cool is with that one little strategy of just selling when there's an inverted yield curve and waiting for a recession, and then getting back in, usually when commodity prices in gold and silver and stuff like that peaks, which is a little bit more complicated. Something we get into more later. But at the core of it, just by focusing on what most people do, which is like totally ignoring that strategy, which can literally double your returns over the long term. People create ridiculously valuable portfolios, and they absolutely crush it in financial markets. Here's my thing, here's my goal, here's my objective for you. You see, most people are getting these normal returns, and they're having phenomenal growth. And so, my question for you is, if you could get just a little bit more, you could get just a little bit more, just a little bit more. I have a trader last week made 187% in 2 weeks. And I can't guarantee results. I can't say results are typical. When you can make trades over and over again, or maybe over the course of a couple of weeks, and they return hundreds of percentage points, or maybe they're over the course of call on flowers for the past 8 days. It's gone up 48%. When you have the ability to make returns that are like infinitely greater than what most people are used to, all of a sudden what it does is it allows you to take this curve, and it's the same curve. And usually there's going to be a little bit more volatility if you're playing in volatile stuff, but it's the same curve in a much like a very, very small time frame. And so instead of this taking a ton of time, you can actually just kind of like eradicate a lot of this time and make it happen a lot faster, right? And by no means is this like get rich quick, because you like cannot approach any of this with the mindset of get rich quick. What we're looking at here on the S&P, which is a baseline for financial markets, and really the base of what we're getting into when we actually dive into individual stocks, right? Like this is considering like, the S&P is a group of 500 or so stocks. And so like individual stocks, obviously, they have more upside with them, but alongside this upside, they also have more They have more volatility. And this is just a natural volatility. This is a natural part of financial markets. Like there's going to be some aspect of, first, like nothing's going to be guaranteed, nothing's going to be 100%, nothing's going to be surefire. If anyone tells you that there is this 100% surefire investment that's going to give you $1 bajillion today or tomorrow, like that's not going to happen. It's not going to happen. But I want you to start off with indices here, because as we get into individual stocks, you're able to multiply your returns and absolutely crush it. And that's what we're going to break down, is this actual portfolio. This is more of a long-term portfolio, right? So you've kind of got like 3 main kinds of portfolios. The first kind of portfolio is the one that's over here. This is the one that most people are actually using, and this is what's called like a long-term portfolio. Now, a lot of times this long-term portfolio could exclusively be index funds. So you just put your money into an index fund, and that's that. You're done. It takes like an hour a year to manage your portfolio when your money's in an index fund. And because it takes less effort, because it takes less energy, because it takes less skill, obviously you're going to have sort of lower returns. You're going to be sort of in the majority of what people are getting. You're going to be with the masses, because most people don't actually care about their portfolio. Most people have this belief that it has to be really, really difficult, or it's super hard to actually make a bunch of money in financial markets, or it takes like 10 hours a day to do it, which is so far from the truth. I literally can't believe when I hear it. But anyway, then there are these 2 other kinds of investment management, right? You've got active management, where you're buying a stock one day, and then you're selling it on the same day. You might hold a position for like 5, 10, 15, 30 minutes, but you're not really holding that thing overnight. There's not a chance I would hold a bunch of the stocks I trade overnight. But those stocks create returns that most people see in a year. Like if I get a stock and have that one stock go up 12% a day and capture that gain, because in reality the stock's usually up like 400%, 300%, 200%, 500%. If I capture that percent gain in a day and then get out of the position, then it makes no sense to not do that, right? If you're in a position where you can make what most people make in a year in one day, like I shove out people and they're like, well, how often should I trade stocks? Like, how often should I do that? And I'm like, well, let's see. If you can make what most people make in a year, in one day, I'm pretty sure you could probably do that over and 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 over again. Like, why would you not do that over and over again? And so that's sort of active management. And the second kind here is, and these are all sort of based on technical analysis, right? These are based on more technicals. And what's cool is I'm actually going to break down a lot of these for you as we get into actually some of the individual positions here. We'll talk about swing trading. This is what we're going to see more of in this masterclass because active trading, like, it only happens in one day, and it's kind of hard. Like I can show you tons of examples, but it's a little bit hard to teach from because stuff happens quick, and when stuff happens quick, it's a little bit difficult to actually see why you get into something because you need to master the skills at sort of a 30,000 foot level first. So like you need to be really great at long-term investing, I believe, before you actually get into swing trading, and then you need to be really great at swing trading, I believe, before you get into active trading. And you can practice starting lower. You can practice starting with active management and then get into long-term investing. And that's how some people start off. But for a vast majority of new investors, really, it makes sense to understand long-term investments, and then understand swing trades, and then understand active investments. Now, what we're going to go through mostly in this masterclass are swing trades. And the reason why is because this entire portfolio is made up of swing trades, and it's also made up of long-term investments. And when I say long-term investments, what I mean is long-term individual stocks. And so when I say individual stocks, what I'm saying is, like, I'm not going to show you some purchase orders of the S&P 500 or me bond and NASDAQ because I'm not going to do that. There is no incentive for me to do that if I can beat the markets over and over and over and over and over and over again. It just doesn't make any sense. And so that's sort of where most people start off. And I'm assuming coming into this that you have like a basic understanding of like you can buy the stock or you can buy an ETF or you understand sort of basic financial instruments. And if you don't, I'll have probably another course before this called the Stock Market Secrets Masterclass or Stock Market Secrets Exposed, and definitely watch that one first and then come into this Portfolio Secrets Masterclass because this is going to be really building on that, and that's sort of going to be your foundation for overarching long-term mentality because you sort of have to understand the foundation of that before you get into individual stocks, before you get into swing trades, before you get into active trades. And so that's where we're kind of starting out here, which is super cool. Now, once you understand that, all of a sudden you get into swing trading, and this is really where you're going to be actually taking positions, and these positions are not going to be as active as day trades, right? You're not going to hold these for half an hour, but they're also not going to be as long-term as sort of an overarching portfolio. Like, you're not going to hold these positions for the next 5 years, for the next 10 years. Instead, maybe you're going to hold these for a couple of days, sometimes a week. Sometimes you might hold these for a month, or maybe 2 months, or 3 months, or 4 months. Sometimes even up to 8 months, or a year, maybe 2 years, but you're strategic about it. And the reason you're strategic about it is because you actually know going into a position, you understand your time frame. So you know your time frame is known going into the position. And that's kind of important because a lot of people, they start investing and they get into a position and they don't actually have an idea of what they want. They don't have a prediction for what they think should happen. They don't understand sort of how they want to get into the position. And most importantly, they don't have a target. Like, they don't know where they want to go. They aren't sure where their upside is. And instead, all they do is they focus on like setting a stop loss and setting a downside limit. And when all you focus on is the downside, like, you're probably not going to succeed because you want to have a point where you actually know where the stock's going to go to. Most people that don't really know their upside and only set a stop loss, they have what's usually about a 1-to-1 risk-reward ratio. And now a 1-to-1 risk-reward ratio, to some people, sounds great. I know a couple of people, they go to casinos a lot, and it's not the same as the market. It's a very bad place to be. And they play craps or blackjack, or I don't know all the games just because I'm not into gambling, but they have these games where there's like basically a 50-50 chance that you will win one way or another. And when they say 50-50, what they really mean is like 49, and then the house gets 2, because the house always wins. And what I want to teach you to do through this masterclass is to actually become the house in financial markets. I want to teach you how to actually learn to count the cards of the game, so to say. Because if you go to the casino and count the cards, you're going to get kicked out the moment that you start counting cards, because you're going to win a bunch of money. Then if you win a bunch of money, the casino's going to lose a bunch of money, and they're going to be super upset, and they're going to kick you out. With the market, with Wall Street, and with investments, you can count the cards as much as you want. It doesn't matter. You can make as much money as you want. Nobody's going to kick you out of financial markets. And so once you understand the game and once you understand how to play it, all of a sudden you sort of start to have a tool that allows you to literally write your own paycheck. It allows you to literally write your own net worth. And that's something I'm really passionate about sharing with you. And so anyway, they go into these casinos and they have these games where it's basically 50-50. And they'll put all the money on one side and all the money on the other side. And they'll just play over and over and over and over and over and over and over again. And they'll expect that they're going to make a bunch of money. Now, I don't know if you guys are mathematicians. I personally not a big fan. But if you risk $100 on heads and $100 on tails 430 times, and you win $100 if you're right, you lose everything if you're wrong, or maybe you win $50 if you're right, lose 50 if you're wrong, or some other way where you're getting the same result and you can still bid every single time. At the end of the day, statistically, you should have the exact same amount of money. Now, I don't think that's a good strategy. A lot of people, they get into financial markets and they start playing the game, and they play the game to not lose. Now, that's not how you want to play the game. You don't walk into a casino to not lose. You don't walk in, and I hate comparing the market to casinos, but you don't want to play to not lose, because when you play to not lose, you're not playing the game the right way. You want to play the game to get geometrically greater returns. You want to play the game to freaking win. You want to play the game to get to your portfolio the amount of money that you desire. And that's sort of the different mindset that'll actually give you way more success, because when you shift from playing not to lose, and you shift from, I want to protect my money, and I want to make safe investments, and I want to do what's the best for everybody, you move that over to this prolific zone of I want to outperform 99% of investors and radically limit my downside. All of a sudden you have a totally different game, you have a totally different world you're playing in, and the reason why is because you actually understand at the core what you need to actually do. What are the actions you need to take to get this end result of geometrically greater returns? And as soon as you have that, all of a sudden it becomes infinitely easier to actually get that end result. And so that's really the core, and that's really the big mentality to go into understanding here, is once you understand that you can actually create so much more than what's normally possible, and all you have to do is shift this mindset of what a majority of people do, getting average returns, and instead just put in a little bit more effort, sometimes a lot more effort. I mean, I probably put more effort in my investments than almost 99% of investors, and because of that, I outperform almost 99% of investors. And so once you sort of understand that you just put in a little bit more, you can actually get sort of a lot out. And when I say a lot, it's not proportional. You put in, some people think you put in an hour and you're going to get a tenth of what you get when someone puts in 10 hours. But in reality, this person who puts in 10 hours, if you kind of think about it as a time block, and this is the person who puts in 1 hour, the person who puts in 1 hour might get this much out, and the person who puts in 10 hours, we'll pretend that this is a way bigger scale, and I'm drawing off the whiteboard here, might get 15, 20, 30 times greater returns. Because once you understand how to actively invest your money, and really once you understand technical analysis, all of a sudden it becomes significantly easier to actually have the upside without the volatility once you know what you're doing. And so that's kind of my goal coming into this class, is I want to show you how to use Yahoo Finance. Yahoo Finance literally changed my life. The reason why is because it gives you access to financial markets. It gives you access to all the information that you can ever need to actually break away from the majority and become one of the best investors, and become one of the highest earning investors on the planet. Okay, does that sound cool? You guys get that? Is that awesome? You excited? I'm excited. You pumped? Alright, so the first step and the first thing we're going to do is really, really, really simple. All you have to do is go to Yahoo Finance. Okay, so just open up a new tab or whatever you need to do, and just go to finance.yahoo.com or Google Yahoo Finance or look it up, whatever, and we're going to go to Yahoo Finance. These guys are literally insane. They're just the best. Okay, all we want to do is just create an account if you don't have an account with Yahoo, or sign into your account if you do. And what I really want to focus on in this class is creating a portfolio to allow you to understand the portfolio. And so to do that, we're going to actually go through some of my real world performance assets. We're going to go through some of my actual portfolio, some of my legitimate investments, and sort of break down why I did that, and why I got out of them, and sort of the mentality behind them. And that's what I want to do, is I want to give you like the actual underlying psychology behind each of the investments, because in reality there's a lot of effort, a lot of energy, a lot of motivation behind every single investment that I personally make. Like, if you commit your money to something, you should understand what the heck you're doing. And usually for me to buy stock, like, I have to look at about 100 other stocks first to actually get into that investment. And sometimes it's more, sometimes it's less. But usually there is a huge amount of investments that you're going to pass up, you're not going to use. And the reason why is because minority of your investments will create a majority of your results. And we're going to see that like in real action coming through with some of these investments. You're going to see some of these investments do really well, and some of them just kind of go sideways. And once you understand how to only invest in the ones that do really well, all of a sudden you're in a totally different ballpark. This portfolio we're about to go through is one I created about 4 years ago, and because of that, like, I didn't understand a lot of the really foundational concepts that I'm teaching you right now and that you're going to learn in this class. And so there's going to be a lot of mistakes to learn from. I'm not claiming by any means that I'm perfect, because there is no way I was perfect, especially when I made this portfolio. But this portfolio has still outperformed every single thing I've ever seen, and it has crushed even hedge funds, index. Like, there's not a single thing I've seen that has done better than it. And the reason why is because of just some really core mentalities behind the investments. And these are investments that I'm not special. Like, there are literally hundreds of millions of people that have made these exact same investments when the exact same time I got these stocks. There were millions and millions of people buying these exact stocks at the same time. Like, I am the same as every other person who owns these exact same stocks. And I just want to let you understand how all those individuals who are outperforming and who are actually crushing it actually got to the conclusion that they should be in those specific investments. And so that's the first step. That's what you need to do right now. Is you got to get in Yahoo Finance, open up an account, and I'm going to go through my portfolio, and I want you to go ahead, and if you don't have a portfolio yet, go to the My Portfolios tab, which is all the way up there at the top, and in the My Portfolios tab, click, create a new portfolio. And if you don't already have portfolios, then this will be your first portfolio. Call it your first portfolio. Your name. Awesome first portfolio. And if you do have a portfolio, great. You can either add this to your portfolio, or what I would recommend doing is creating a new portfolio and calling your name Awesome New Portfolio. Okay? That sounds awesome. That's your step. That's what you got to do. And I am super excited for you, because you're going to learn so much. And with that said, I will see you in the next module where we actually break down the first secret investment. Okay? Sound awesome? Thank you so much. And I will see you in the next module. Bye.